So let's go back and run through our monetary policy. So what we're going to be looking at is this side of the business cycle, and I know we wrote this out, but this side of the business cycle is the expansion. And we know in an expansion our problem is demand pull inflation, that we have too many dollars chasing too few goods. And so when the Fed looks at this, they're like, oh, there's too much money out there, right? So we need our goal. Our big goal is to reduce the money supply. So the Fed, what they're going to run is a tight monetary policy, which they will increase the reserve requirement, which means banks are holding more or less money. More, and so they can lend out less, which reduces the money supply. The government is going to sell these bonds, and when they sell the bonds to you, what do they take from you?
Money.
And now our money supply decreases. And the last thing is they're going to increase that discount rate, where banks are borrowing from the Fed or they're borrowing from each other. And the overall impact is that our supply of money will decrease, causing the interest rate to go up, which the impact is that we will see the increase on the interest rate, and it's going to slow the lending practices down. And in the end, what has happened to my money supply? It has what? Gone down. So now let's look at the other side of this business cycle. So I want y'all to tell me, what phase are we in now?
Recession.
Okay, we're in a contraction / recession. Recession is 2 consecutive terms of slowed growth. So our problem over here, we said it was inflation on the other side. What is our problem on this side?
Deflation.
Not deflation, unemployment. Unemployment is over what?
6%?
5 to 6%. Those are just the, we like to see our unemployment around that number. Right now it's about 3. So what are we in? Expansion. So the graph for this, we're going to have price level. We're going to have real GDP. Which way would my aggregate demand curve be? To show people are not buying stuff, people are unemployed. To the left. So if people are unemployed, what does that tell us about their capability of borrowing? They can't, right? So our money supply is very what? Well, if people are not, it's low, right? So the Fed, do they need to tighten up the monetary policy? They need to ease it. So the Fed's policy will be easy monetary policy. Their goal over here is to increase the money supply. So let's look at their tools. For reserve requirements, if they want more money out there, what are they going to do to that reserve requirement?
Lower it.
They're going to lower it. Okay, now we look at bonds and securities, which we call open market operations. They need to get more money out there. Remember, what is Colton holding in his hand?
A pencil.
No,
A bond.
a bond.
The metaphor from earlier.
What we were talking about earlier. Yes, thank you for the literal. Remember earlier, I had given him a bond, and what did he give the government? Money. And now he's holding that bond, and it's matured, like Eric has told us. So what does the government give him? The money. So they're buying it from him, right? And now they give that back. So this is when the government buys back those securities. The discount rate, which is the rate of interest that banks charge each other. What's going to happen to this? It's going to lower it. I just put an arrow because I didn't have enough space, sorry. So overall, all of these tools, what is this going to do with my money supply? Increase it. Come and grab this. Okay, so because of all of these things that increase our money supply, which way will our supply of money graph go? To the right. So what has happened to the interest rate?
It goes down.
And does that encourage more people to take out loans?
Yes.
So the impact. Okay, this is everything that you should have gotten in your reading, except a couple of other things, which one I'll do through a PowerPoint. Okay, how do y'all feel about this now?
Great.
Right? Because now it should be formulaic. When y'all start seeing this, you're like, okay, they're going to say that the economy is in this phase of the business cycle, that there's 10% inflation. You should automatically go, they're like, oh, these are the tools they're going to use. They're going to increase the discount rate. They're going to sell OMOs. They're going to increase the discount rate. Well, if there's 10% unemployment, the government is going to do the exact opposite. And the reason why I'm saying this is because you're going to see things on the free response and on the multiple choice that are going to give you these tools, or they're going to tell you what's going on in the economy. So the other portion that was part of this was talking about the Fed. Okay, so we're going to look at that. And that was part of y'all's reading. So we're going to look at the lecture of the Fed. And I have this for y'all. I just didn't think we were going to have to do it, but okay. So did someone still need the thing, or were y'all good? Y'all copied it? Everybody good? Okay. So we're going to look at the Federal Reserve. And again, the Federal Reserve was created in 1913. It was created under Woodrow Wilson's administration. And it's basically our nation's central bank. The United States had a central bank before this. Do y'all remember Alexander Hamilton? Yep. And he created the bus. If you had last year, me, and we read about Jackson killing the bus, right? And how it sent us into economic shambles. And then we talked about in the Civil War, another bank being created. After the Civil War, this will be the bank that we presently have today. Its functions, just like we saw the Bank of the United States that Alexander Hamilton created, it serves the government. It is the main depository of the government's revenue. Also, it services the banks, it pays the government's expenses, and it regulates the money supply. So y'all know today, how many of you ever gotten an income tax refund? It comes from the Federal Reserve's Department of the Treasury. We're going to see all the money that y'all have. I was just doing Jackson in the Bank with APUS. These are all Federal Reserve's notes. And so that's one of the things is they're going to regulate the money in there. Everything is tracked. I think we talked about this last year. And this is how they circulate money out of the system. We're going to see that the Federal Reserve is set up like this. They have a board of governors. And these are the people who give advice to the president on the state of the economy. You know what we just did on that chart? They look at it, they say we're in an expansion, and they say, Mr. President, we are going to reduce or increase the reserve requirement. And Trump, does he want that? No, we actually don't have an increased reserve requirement. Our discount rate and the selling of that stuff is actually, we're doing the opposite policy, right? And we are going to see the Federal Advisory Council will advise the banks, which there is 12 regional banks. Our bank is in Dallas, the Fed. And they look and monitor what banks are doing. They go out and look at their lending practices. They make sure that they send auditors daily to see that whatever the bank has, they're keeping on reserves, how much do they have in their vaults. So they basically create those T-charts that we did, and they advise of them. The Federal Open Market Committee is the one that looks at the buying and selling of bonds. Remember that tool? And so this is the government putting more money into the supply, because essentially it's creating a piece of paper, right? And when they sell it, they're going to take your money. So what happens to that money supply? It goes down. And when the government creates securities, they're creating money, okay? So they create securities to be able to fund their spending, okay? And so that's one of the ways that our money supply is increased when the government puts securities out there. And so these regional banks will then look at our local banks, yes.
So is it illegal to destroy money?
It is because it's a legal tender.
Because you're tampering with the money supply, essentially?
Yes.
Is it illegal to throw it away?
And that's why you could throw it away if you choose to.
Right.
And my mother-in-law all the time, she just thinks she could throw it in the trash, and we were going through the trash, we found it. It's perfectly fine. But that's why they take that money out of circulation when it's been tampered with. Like a bank will take a $100 bill that has been shredded, like not shredded, but like I showed y'all last year, remember that money that I had shredded in a little bag? Because the Fed shreds the money because then it gets that out of circulation and will create new money to replace that. Yes.
So if I like tore up a dollar bill, then I picked it back up, could I like give it to someone and it would still be valid? I can still
Yes.
do stuff with it?
Yes, but oftentimes you take it to the bank because the bank will agree with it. Most business institutions won't because it's hard for them to process it because they have those little. Have you ever seen them count money at a business that they put in the little counter? And when it's torn up like that, they don't take it. If it's like one or two pieces, yes, they will. But a bank, if it's torn up in several shreds, like your cat got a hold of it, the bank will give you another one because they, again, respond to the Fed. That money will then get out of circulation and the Fed will replace it.
We count all of our money by hand.
Really? I'll show y'all a video on the Fed in a second.
It was so relaxing to watch.
You're watching it. Okay, so the Board of Governors, they control the activities of the Fed. The chairman is no longer Ben Bernanke. It was Janet Yellen, and then Janet Yellen has been replaced by someone who Donald Trump decided, which I don't even remember the guy's name. Okay, because I haven't updated this. The Federal Opera, we talked about them controlling the money supply. The more money they put out there, we see that has an impact on our interest rates. The Federal Advisory Committee provides the Fed with advice on the national's financial problems and what we're going through. So we're going to see district banks perform the functions of the commercial banks, looking over what people spend. And at the local level, these member banks we use for our own banking. And so we know the Fed provides government services. They are the banker for the federal government. They conduct the securities auctions. So it seems weird, a securities auction. Basically, that's when they're auctioning off securities, pieces of paper saying that they have value. And when the government's saying that and they're selling it, the government's taking in money. But when the government buys that back, that puts money out into the system that was never there. That's the creation of money. Yes.
So let's say I buy a bond from the government for $100, right?
Yes, and you give your money to the government.
Right. Can I then sell that to Denton for, let's say he wants to buy $200?
No, because what happens with bonds and securities, I'm eventually going to get to this in personal finance. Whenever you buy a bond and security, you're the loan holder. You can no longer sell that.
They're non-transferable.
Exactly.
Okay, so if Denton did want to buy it,
He has to go to the government and buy one.
okay.
And so now the government takes his money away.
Why would you buy it?
So
Okay.
could Cole
Because you'll get money in the future when it matures at a good
Okay.
interest rate.
Okay.
Remember we talked about when you invest in your savings account, you don't make much money.
Okay, so
These
it's not
have-
investing.
This has a higher rate of investment. So let me show you something. Let me interrupt this.
So is that why people
What's
say
the
bonds and
normal
securities
interest rate
are
for
quote
bonds?
unquote safe investments?
It just depends on how much you're putting in to it.
So like normal $1,000 bonds.
You're probably getting about 4%.
If you're putting in 10,000, then would you get better?
Like
Or,
Yeah, the more you put in, the more you get. Risk and return. Okay, so what I'm talking about here, I'm talking about government treasury bills, securities, and bonds. They are the lowest interest rate you'll get, but they're the most secure. When I look up here at junk bonds, okay, so I'm just gonna make up a junk bond that actually existed. Y'all know Viagra.
Yeah.
Hey, it was one of a lot of our junk bonds are like these medical new type of things that are very questionable.
Like clinical
But-
trials?
Yeah, they're in clinical trials, but it's a very risky thing, right? You could either gain a lot of money or you could lose a lot of money. So these junk bonds, yeah, the risk is up there, but could you make a good interest rate? However, over here, when I look at the securities and the government bonds that they're selling, these are very secure, but are you going to make much? No, but you're probably going to make more than the rate of inflation, yes.
So preferred stock is like blue chip stocks like Apple,
Yes.
Chase.
Yes.
Common stock is
Walmart's. Okay,
And,
and
then
it prefer and speculative stock. This is where, okay, this is things like there's the Nasdaq, okay, and then there's the Poor Richards, and then what we're looking at, our speculative stock is more of the technology. No, more of the technologies. Okay, more of the technologies. Investment grade bonds, these are things when you give to a business and they're promising you that back at a rate. We will get to all of this stuff. Y'all are interested in money. This is personal finance. I'll get to it. But do you understand why there is a return, but is it as much as you would think? No, because you're going to get your money from the government no matter what. And so that's the rate of interest is very low. Does this explain what we were asking? What was asked? I can't even remember what was asked. Okay. And the last thing you know is that they issue currency. Okay, so the bank services, remember we talked about the check clearing? It used to be that you could write a check and then 7 days down the road they would take it out of your account. But now it's automatic because of September 11th, because all of our planes are grounded. They also supervise lending practices, and so I don't think any of you have ever taken out a loan before. But what happens is they're going to look at the whole process of the application to make sure that people are getting appropriate loans, and so that we wouldn't have like a huge fallout of our economy. Also, I talked about this, bless you. Remember when Hurricane Harvey hit, did they want to have their plastic or did they want to have cash? Cash. And so all of a sudden, the Dallas Fed realized there was an issue in Houston that did they want to deplete their whole checking account?
Yes.
And so because of that, they knew that the Fed would have to step in and be the lender of last resort, that they probably needed to help some of those banks out. But they're going to charge them that discount rate to be able to get that money to them. Okay? They basically coordinate all the regulatory activity about the reserve balances, and they examine banks to make sure that their practices are adhering. Yes?
So I like how in someone like in the 08 crash, how people just started running banks dry of money.
Yes, because everybody was like, well, I'd rather have my money in there. But we know when banks don't have money, they won't have money to lend out, which leads to economic growth. And so that's why they're making sure that these banks are adhering to all of that. And they're always been the lender of last resorts, because where this is coming from is called Keynesian economics, that our government could come in and prevent our highs from getting really high and our lows from getting really low, as long as they monitor our policy. Yes,
Okay,
Joshua?
so how does that work if the actual recession itself is because of loans like we saw in 2008?
That is because our Fed was, and like we see today, our Fed is not running the right policy. And so our Fed, which it's supposed to be, these people are not elected by anybody. And so because they're not elected, they've seen that they have the best interest of our economy at heart. But the president of the board, the chairman, is appointed by the president. And so that's where a lot of people are saying, well, if he's appointed by the president, he's probably thinking about, well, I got appointed here, I need to run that policy. So this is why, and I'm going to show you a little video that will go over this, why they're supposed to be independent, but why sometimes they haven't changed the policy, because we were running like on a 0 interest rate for a while after the housing crisis, and they slowly increase that, because they can't dramatically increase that, because that will send jolts into the economy. And so now we are to a point that they're actually running the easy monetary policy when they need to be running a tight. And so where you're saying the question is why aren't they changing this? Well, we actually don't know where we are in the phase of the business cycle until 6 months later. So we're reacting to a problem that's already there. Okay? And so then the Fed, they want to see consistency. How long has this problem been a problem before they react? Yes?
Well, what I was wondering is, like, so he was talking about how people took money out of the banks
Yes.
and didn't make loans because of the recession. But if the recession is based off of loans, then how?
That's when the Fed comes in and they start looking at those lending practices. And they start saying, well, we're going to send in auditors all the time to audit banks, because a lot of them were making bad loans for adjustable arms where people did not have the amount of money coming in to be able to pay off that.
So the government just audits them?
Yes,
Okay.
and that's the main thing.
Whereas
It's
in 08,
partially due to
they were
neglect.
Yes.
auditing banks, whereas now they are supposed to actually audit them.
Yes. Right. So last thing, the Fed solution is to look at full employment. And full employment means that we need to have lending practices that could get businesses money so that they can employ those people, economic growth, and last, price stability. Right, so I'm going to show you a video, and this is just in plain English. It's a cartoon video, but I promise it will clear up a lot of issues that we are having.
This is what I think it is.
Huh?
Is what is it called? I'll let it play. I'm not gonna.
I don't think it's a video you're thinking.
What's that?
What does plain English mean?
It means it's dumbed down.
Never mind.
It's in layman terms.
In plain English. That's literally the name.
Oh.
Okay.
I was thinking of schoolhouse. Alright.
It's muted.
Personal tour guide to the Federal Reserve. I'm here to introduce you to one of the most complex but effective institutions in the United States. But don't worry, I'll explain it all in plain English. Just beside me is a roadmap of where we're going. Together, we'll walk through the Federal Reserve System, literally. And along the way, I'll show you just what goes on around here and why it's important. By the end of this tour, you too will be able to explain the Federal Reserve in plain English. As you can see, there's a lot going on around the Fed, but keep in mind that the whole is really just the sum of the parts. Basically, the Federal Reserve is made up of three parts. The Board of Governors, that's the building on the far left, the Reserve Banks, the 12 buildings along the right, and the Federal Open Market Committee. The complex design of these three parts is actually tied to how the Fed was created in the first place. To understand the structure better, let's first step back about 100 years. You've probably heard of the bank failures that occurred during the late 1800s and early 1900s. Back then, the failure of one bank often had a domino effect, in which customers of other banks rushed to withdraw funds from their own banks. These banking panics wreaked havoc, even on financially sound banks, and sometimes paved the way to serious widespread economic recessions. When Congress wrote the Federal Reserve Act in 1913, one objective of the Fed was to help banks acquire emergency cash reserves to meet such panic withdrawals, so that the shortage of funds at one bank didn't disrupt the entire banking system. This function would go a long way in establishing confidence in the banking system and more stability in the economy overall. Another goal of the Fed was to improve the efficiency of the national payment system by making it easier for payments, mostly checks, to be exchanged through different parts of the country. To achieve these goals, the Fed, then and now, combined centralized national authority through the Board of Governors, remember that on the map, with a healthy dose of regional independence through the Reserve Banks. A third entity, the Federal Open Market Committee, brings together the expertise of the first two in setting the nation's monetary policy. Okay, that was a mouthful. Let me see if I can make better sense of it. Let's take a walk through some of the places that make up the Fed, where you can see firsthand what exactly we do. I'm here now in Washington, D.C. Behind me is the Board of Governors, which is a U.S. government agency. The board has 7 members, called governors, who are appointed by the U.S. President and confirmed by the U.S. Senate. One thing the governors do is write the regulations that make commercial banks financially sound and that make the nation economically strong. It's the governor's jobs, along with economists and support staff, to study trends in the economy and to help forecast the country's future economic direction. The governors also oversee those 12 reserve banks I showed you earlier. Probably the governor's most important responsibility, however, is participating on the Federal Open Market Committee, or FOMC. Speaking of the FOMC, the meeting room is right next door. Let's take a peek inside. I think a meeting is just wrapping up. Looks like we're right on time. Straight ahead is the FOMC, the Fed's chief body for monetary policy making. Here, the 7 governors from the Board of Governors meet with the presidents of the 12 reserve banks about 8 times a year to discuss the current state of the economy and how to promote steady and sustainable economic growth. While everyone here participates in the discussion, only the voting members actually vote on any actions that the FOMC can take to influence monetary policy. Oh, and when I say voting members, I mean the 7 board governors, plus the president of the Federal Reserve Bank of New York, and 4 other Reserve Bank presidents who serve on a rotating basis. As we've just seen, each FOMC meeting ends with a vote on actions that will affect the country's money supply. Not how much is printed, but how much money banks have to lend, which in turn affects the amount of money consumers and businesses have to spend. We'll talk about this more in a minute. Before we do, though, let's follow this Reserve Bank president back to the office to see what goes on there. Buckle up, we're headed west. In all, there are 12 districts in the Federal Reserve, and each is served by a regional reserve bank. Many also have 1 or more branches. As we'll see, reserve banks have 3 main responsibilities: providing financial services, contributing to monetary policy, and supervising commercial banks in their regions. Now don't worry if you didn't catch that the first time through. We'll take a look at each of these activities one by one. First, let's head to the financial services area and see why a reserve bank is often called the banker's bank. This floor is busy round the clock, which shouldn't surprise you. This is where the Fed's task of providing a safe and efficient method for transferring money throughout the banking system takes place. Every day, banks deposit billions of dollars at the Fed in cash, checks, wire transfers, or some other form of electronic payment for many of the same reasons we consumers use a bank. In addition, reserve banks offer payment services to all financial institutions in the United States, no matter what their size or location. For example, that fast-paced clicking sound you hear is a high-speed machine that sorts thousands of paper checks every minute and puts them into bundles to be rerouted to financial institutions. We've got machines like this that sort currency too. And over there, through the glass, you can see the computers that transfer money electronically from one bank to another. Companies offer these services as well, but the Fed is a primary player in the business. By the way, even though the Fed competes with other businesses in the financial services it provides, the Fed stays in the marketplace primarily to promote competition, innovation, and overall efficiency. Besides serving commercial banks, reserve banks also serve as banks for the U.S. government. We maintain accounts for the U.S. Treasury, process government checks, and assist the Treasury in issuing and redeeming securities. There's plenty more information about this on our website. It's getting noisy on this floor. Let's go visit the research department where it's a little quieter. As you might guess, one of the most important jobs of the Fed is to keep our economy healthy. We do this by managing the nation's money supply, or what teachers call conducting monetary policy. This isn't easy to explain, but let me start by telling you what the economists do. Economists at reserve banks are all experts on different aspects of our national economy. These economists pursue their own research interests and contribute to a broad exchange of ideas across the Federal Reserve System. If you hang out in this department for a while, you'll notice that economists often hold firmly to their individual opinions and are known to debate their points of view with one another. Despite their varying perspectives, Most economists agree, though, that the economy performs well when inflation is low and stable. As a result, low inflation is a long-term goal of the Fed. So, what do the economists do with their research? A lot of publishing and a lot of public speaking before all types of audiences. But their most important job is to prepare their Reserve Bank president for the FOMC meetings we poked our heads in on earlier. At the FOMC meetings, members together set a target interest rate called the federal funds rate, which is the interest rate on overnight loans between banks. This rate influences other interest rates, like those for mortgage loans, and greatly affects the direction of the economy. To hit the Fed funds rate target, the FOMC issues a directive to the New York Fed's domestic trading desk, which will then buy or sell U.S. government securities on the open market. You're going to have to trust me on this one, but ultimately, this action of buying or selling securities affects how much money banks have available to lend to you and your family or business, and thus either increases, decreases, or maintains the growth of the money supply in the banking system. Speaking of the banking system, let's tag along with this bank examiner heading out to a commercial bank. To see what these guys do, you have to hit the road. As you might recall, Congress created the Federal Reserve to foster safe, sound, and competitive practices in the nation's banking system. To accomplish this, the Fed both regulates the banking system and supervises certain types of financial institutions. In case you're wondering, these types include state-chartered member banks, bank holding companies, which are the companies that own banks, and international organizations that do banking business in the United States. There are other types of banks that are supervised by other regulators. So, what's the difference between regulation and supervision? Bank regulation refers to the written rules that define what is acceptable behavior for financial institutions. The Board of Governors in Washington, D.C. takes care of this responsibility. Supervision refers to the enforcement of these rules, which is carried out by staff at the 12 reserve banks. Fed examiners, like those here, visit commercial banks and look over the bank's financial statements to evaluate the quality of assets, internal controls, and ability to manage risk. Now, why do you care? Because you've got money in this bank. The examiner's job is to make sure your money is safe and sound. Examiners also review a bank's performance in complying with federal and state laws. At the end of an on-site review, Fed examiners issue the bank a rating that reflects whether the institution is in good shape or whether it has weaknesses that require corrective action and close monitoring. One of the most important ways that the Fed ensures safety and soundness of the banking system is by helping banks respond to all kinds of crises. One way the Fed does this is by making short-term loans to banks through its discount window. This not only helps individual banks and their customers, but also ensures that a shortage of funds at one institution does not disrupt the flow of money and credit in the entire banking system. Well, here we are, at the end of our journey. I guess you could say the buck stops here. As promised, I've introduced you to the 3 big stops on the Fed tour: the Board of Governors, the FOMC, and one of the 12 reserve banks. I've also described our 3 main responsibilities: providing financial services, conducting monetary policy, and supervising banks. I hope my plain English style has helped you make sense of the complex yet effective design of the Federal Reserve System and how we contribute to a healthy economy. And hey, if you're ever near a reserve bank, don't forget to stop in and say hi. With all this savvy knowledge under your belt, I just may recruit you to give the next tour. Oh, and in the meantime, don't forget to visit our web.
You could actually get free tours of the Federal Reserve, and they give you fun little shredded money at the end if y'all want to go. But did this explain y'all's questions now? Like everything we've gone over? Some of y'all tuned out. Y'all were done. Someone started talking. Yes, Aaron? I know. Okay. But,
So, legally, what keeps the people on the Board of Governors from, like,
running amok?
from essentially running amok, shorting the
Because,
market, doing whatever they want to do, and
These guys are,
Making
most of
tons
the
of
appointments, most of these appointments have always been economists to be on the board. So the guy who's now in charge, Jerome Powell.
right, and that's great.
Yeah.
What I'm saying, but what
They
keeps
are-
them from just making
them-
wild predictions about the market and betting in the favor of that
And
happening?
so is
then
they
just
all
letting
sit
it
down
happen?
and they have these meetings, like the 7 board governors, and it has to be a consensus on their arguments of what they're gonna do with their policy. And so that's why people, they have not raised the interest rates, they have not increased the reserve requirements, cause they were like, okay, well, it's 3%, and how long is it gonna stay that way? And they sit and they have these discussions.
But it's like what I'm saying is like, I'm assuming the financial world, people
Yes.
pay attention and listen to what they're saying.
Yes, and that's why Jerome Powell, like when Ben Bernanke was there,
Mhm.
Ben Bernanke would never make anything on the record. That's why nobody knew his name. But if Ben Bernanke made a comment saying that our economy is not looking good, it would send the markets into chaos.
Right. So what I'm saying is, what legally keeps him from making a statement like that?
Because they know how much their moral suasion could cost, and that's why they don't do it. Because like if you see like what Trump's doing daily and all his comments and stuff,
Right.
it sends our markets up and down, up and down. And so these economists, these are like well-seasoned people. They have PhDs in a.
And I'm
And
saying
they
that's
don't.
great, but what keeps the greed of like making money off of them being able to just make a couple of comments?
Because
What
these
keeps someone
people
from
are
doing that?
passionate about it.
So it's just human will,
It's just
essentially.
their passion for the
They already
economy.
deal with numbers all day. If they have a passion for a whole bunch of numbers, they gotta.
Yeah, and so like Janet Yellen, like her appointment, like under the Obama administration, like people would try to be like, oh, you have to talk, you're a woman. She's like, no, I won't say anything because I know the comment I make will have ramifications.
That seems very dangerous, doesn't
Yeah,
it?
it does, and that's why these people never make comments. And so when the housing crisis happened under Ben Bernanke did come out and he knew if he made comments that he could sway the public to easing the lending practices. And so that's why you don't hear them come on TV, these people. They're never on the TV. That's why no one knows their names, because I had to go back and look up Jerome's name. And I remember I was like, he doesn't look like a Jerome, and that was my whole thought when I heard his appointment. They won't make comments. Which is
Do you
astounding.
get what I'm saying?
Yeah,
Like, that's great that they won't, but
because they
there's
have,
nothing keeping someone from.
They're the one
Yeah.
political figure that knows when to shut up.
Ah,
Yes.
That's scary.
It is. They have an immense amount of power, and you will never hear these people speak up because they know how much power. They
Unless
actually
they
have.
decide to.
They actually have more power than the president. If they were to go
Yeah.
out there and say anything, these people could set our economy
I mean,
rolling.
if all 7 of them said our economy is spiraling downward very quickly, essentially they would speak it into existence.
Yeah.
I'm sure they get a couple of donations from a few people though.
Yeah. Well, no. These people,